Very good. So, good morning, everyone. It's Take Your Child to Work Day here at the Capitol. So we have lots of mini-me's roaming around, which is great. It's the first time in many years we've done it. And I really find it fun. So our first matter of business is amending the resolution regarding the revolving credit facility. Over to Hazim.
Good morning, everybody. Before you is a resolution to amend a resolution previously approved by the board in July 2021. At the July 2021 meeting, the board authorized CHFA to procure additional credit lines totaling 100 million to preserve single-family loan prepayments, a precious CHFA resource for future loan originations. The resolution is set to expire on July 29 of this year, and CHFA is requesting the resolution be extended for another 3 years. As a quick recap, the board authorized CHFA to procure credit lines for loan prepayments preservation at the March 2021 and at the July 2021 meetings. Due to a drop in loan prepayments in 2023, CHFA allowed the March 2021 resolution to expire, leaving the July 2021 the remaining outstanding resolution. While loan prepayments have subsided from their previous high, there will always be loan prepayments, and as such, it is important for CHFA to preserve them for future loan origination. I'll be happy to answer any question regarding the resolution this morning.
Azim, what are you paying on the LLC?
Daily SOFR plus a spread.
SOFR plus a spread. What's the spread?
Currently, the extension is plus 63.
So SOFR plus 63?
Yep.
Thank you.
My question is, so you had a facility that you let lapse, and now you're going to put it, are you going to go back to the same bank? And who is the bank, or are you going to do a process?
So when we went with the March 2021 resolution, we entered into an agreement with US Bank, and that is the resolution that we lapsed. When we went and received authorization for the July 2021, we entered into agreement with Wells Fargo. So prior to the presentation this morning, we did request solicitations from financial institutions. And when we reviewed, the incumbent provided us with the best proposal. So subject to the approval by the board this morning, we expect to extend the existing line with Wells Fargo.
And it's taxable.
Yes, it is taxable. So it's taxable to preserve, but
right.
Once we issue the bonds, it will convert back to tax exempt.
Tax exempt, yeah. But it's taxable to the provider.
Correct.
Yeah.
And who was the other facility with, if you could remind, or maybe you just said
the US Bank one. Remember,
okay.
Last November, US Bank was the original one, and then because prepayment dropped, we let that one go.
Yep. Okay. May I have a motion?
I'll move, Sherry.
I have a second.
Second.
And any further discussion or questions? Oh, I see one from Commissioner Perez. Please ask your question. Commissioner Perez, you have a question.
I do. Can you hear me?
Good morning.
Good morning. If this question was answered because I was in there. So
Can't hear you too well.
How about now?
But much better.
Better.
Okay. If I missed, if this question was answered because I came to the meeting a minute or two late, when you say that West Fargo was better, in what sense was the rate better?
Rate.
Can you refresh my memory? What was it before, and what was it that West Fargo offered?
Oh, so what was it before is what I was trying to explain was the existing line is expiring, and before we would extend the line, we solicited requests from other.
I got that part. But what I didn't hear was that the line before was, say, prime plus 1, whatever it was. And
Yeah.
now they're offering, you know, prime plus 0 or whatever the number is.
Right. So Wells Fargo offered daily SOFR plus 63, and other providers basically offered something higher than plus 63. So their proposal was the most financial beneficial to CHFA. Cheaper to us, the least expensive.
Okay, and it had nothing to do with the line was evergreen. Meaning typically banks like to have a line to have at least, you know, 30 days where there's zero balance. And if it doesn't have it, when renewal comes up, they normally don't renew it. So this is strictly has to do with the rate. Hello? Can you hear
Yes.
me?
Yep.
Okay. So I asked the question.
So it's just based on the rate, on the borrower.
Yes, right, on the rate, nothing to do with the fact that the line was basically, that the line had a balance and it didn't have a, and it had a balance throughout the whole year. Because normally banks like lines of credit not to be evergreen, meaning that has a balance every single month, that there's a period that it has a zero balance. So I just want to make sure that we fully understand
So
the
these type of
recommendation.
credit lines, and I believe you're very familiar with it. There's a unused fee and there's a use fee. So the quote that I provided, the daily SOFR plus a spread, that's the use fee. So the unused fee for this line is 30 basis points.
And the all line was what?
The line was, or the line is, the proposal is daily SOFR plus 63.
Okay, but the use fee that you has mentioned, is
Yes.
it the same? Is it better? Because, let me rephrase the question. When you take everything into account, you're saying this particular line is still a more cost-effective option for us.
Correct.
It's not simply the rate, because what I'm trying to get at is there's more than the rate. There's also the use fee.
Yeah.
Okay, you're saying everything is fine?
Any other questions or discussion? I'm gonna call for a verbal vote. All in favor?
Aye.
Aye.
All right,
Any abstentions? Any against?
We should record, because we did the roll call earlier on, that Commissioner Perez and Tim Hodges were not present at the time.
Okay,
But for the vote, we should at least.
yeah, but it was obvious I didn't vote no, I was saying, so,
Yeah,
but it's okay. If you want to do roll call, it's fine, but I think the way that the chairperson did it is fine too.
no, we just wanted to make sure that, like, because we are just doing the verbal, or basically the visual, that everyone is recognized.
so the minutes will reflect that there was a vote from Commissioner Perez and
And it was unanimous.
Tim Hodges.
It was
Yeah.
obviously that I was there before the vote because I spoke. But if it makes you
It's
feel
all
happier,
recorded
it's
anyway,
fine with
so.
me. Yeah.
Okay. Now, the next item is the presentation of the financial statements. I just want to note, CHFA continues to be a very profitable corporation. We should not let that pass us by. And that's to be commended. But one of my questions, maybe it's for Terry. So the board, the finance committee nor the board actually votes on the annual financials. Is that correct? I mean, we're just getting a report. It's actually just a report. I was thinking it would require a resolution, but I'm
I
sure.
don't, we've
No,
never done a resolution, Madam
okay, that's fine.
Azim, is that correct?
Yeah,
Yeah.
we just present to the
It is
board.
what it is, I guess, right? Okay, well, over to Hazim on the 2023 audited financial statements.
Sure, thank you. So we have here with us this morning, Tom Goldfuss from Whittlesey, who's going to present the 2023 audit result. Before I hand it off to Tom, I just would like to take this opportunity to provide a high-level recap of the 2023 financial statements. Homeownership made the biggest headlines, where we funded over 3,100 loans, or almost double of what we did in 2022, or 1,600 loans. For multifamily, we continue to produce the same number compared to 2022. Non-current assets and bond payables increased to 4.8 billion, and we anticipate bonds payable will cross 5 billion in 2024 for the first time in CHFA history. So does anyone has any questions before I hand it off to Tom? If not, Tom, take it away.
All right. Good morning, everybody. Thank you, Hazim, and thanks to everybody for having me. We're here to present to you the audit results of the 2023 audit. The document, there you go, in front of you, that is on the screen. If you go to the next page, I'll introduce to you the senior people on our team, which is the next page. My name's Tom Goldfuss. Lisa Wills is another partner at Whittlesey. She does she works with me on this audit and does the quality control review and the second partner review after we've done our work. Naomi and Aina is our manager. She focuses on the compliance piece of the audit with the state single audit, the federal single audit, and those programs. We had another manager on our engagement for 99% of this. She just left within the last week or so. And then Julianne is our supervisor. We also have several junior staff team members, internal resources, and IT specialists that also help us with this engagement. The next page is an overview of our audit results. Everything is good news. We've issued an unmodified opinion on the financial statements. We've also issued unmodified opinions on the major federal programs, the major state programs, as well as a clean report on internal controls over financial reporting and on compliance. As part of our audit, as I briefly mentioned, we do an IT review of the IT environment, which is general IT controls, specifically as they relate to the financial reporting process, as well as some other controls. And we did not identify any weaknesses or areas that need your attention or focus when it comes to the financial reporting process. We did not have any difficulties in dealing with management or anyone else with CHFA. Completing our audit, we were able to complete our audit on schedule. We did not have to deviate from any of our audit planning. I know that we had met previously several months ago to go over our audit plan. And again, nothing changed from our audit plan as a result of any of the work we did or any of the things that we discovered as we did our audit. As I mentioned, the internal control reports and compliance reports did not identify any findings or non-compliance. As part of our audit, it's designed to consider the fraud risks and risks of material misstatements, and nothing came to our attention that would require us to disclose that to you. And there were no misstatements that would require any correction at all, whether they be material or not. It's possible that during an audit, an error is identified that does not necessarily become corrected, whether that be due to materiality, timing of when a transaction occurred, or differences in accounting application. And we're not aware of even anything to that level that would be required to communicate to you. On the next page, our audit standards require us to communicate to you several matters as it relates to the audit. This comes in the form of formal letters and also in meetings such as this. We performed our responsibilities under generally accepted auditing standards as well as government auditing standards. That's due to several reasons. Being a quasi-public entity in the state of Connecticut, it's required, but also due to the state and federal programs to you. We communicated this on August 5th, 2022, when we were first engaged, and we've maintained those standards in the course of these last few audits. We're not aware of any deviations in the judgment about the company or management's accounting policies. All accounting policies appear appropriate and have been consistently applied. No significant accounting policies were changed during the audit. Nothing was changed that would result in any type of misstatements or judgments that would affect the numbers that you're seeing in your final audits. Management does represent to us that they've complied with all of our requests, so no issues there. During the audit, we evaluate key factors and assumptions that are used to for accounting estimates, the most significant being the allowance for losses. We audit the assumptions. We do detailed testing of certain loans and why reserves are what they are. Make sure that you're following your policies and that they're consistently applied from year to year. And we did not identify any issues there. We also look at the net pension liability, the swap portfolio, fair value of investments, and all estimates appear to be proper. As mentioned previously, we're not aware of any fraud or illegal activities, nor were any material weaknesses identified during the audit. There were no disagreements with management. We did not have any difficulties in performing our work at all. The team's very great to work with. Our primary point of contact is Allison Murphy during the audit. And once again, very pleasant to get through the audit and pretty easily and make sure that we were on time with everything that we were asked to do. We're not aware of any differences of opinions, meaning any other accountants or CPAs being consulting to verify or get a second opinion on anything we've said. And then finally, most importantly, as required, we have maintained our independence with respect to CHFA during the course of our audit, so we confirm that to you. On the next page are some of the significant audit areas and our responses to these, and I won't read these in detail. It will take far too long to do that. I'm trying to be conscious of your time here. But some of the things that we spend the most time on, the required supplementary information, is primarily the MD&A. We do procedures on that to make sure that those records, that information agrees to the accounting records, as well as the audit. We don't express an opinion on the MD&A, but we are required to read it, make sure that the information is consistent with management's responses. The schedule of expenditures of federal awards, as well as the state awards, are a summary of your major federal and state programs. We do detailed testing of those programs and as well as the controls to make sure that the amounts are appropriate, that the amount was recognized in proper periods, and that the compliance was followed. That information is audited and reconciled to the underlying accounting records and thus the financial statements, and separate reports are available on those. The supplementary information primarily consists of the pension information, and we review that information to make sure that it agrees to the underlying assumptions as well as reconciled to the state information that's provided. On the next page, we continue. One of the significant risks that's presumed in all audit is management override of controls. So we review not only detailed testing of the cash receipts, cash, loan reserves, and investments, debt, payroll, grants, and the financial closing process, but we're also looking at journal entries that are involved with that. So if we know the controls work well, an override of controls would primarily be management journal entries. So we do test journal entries, which are part of the financial process, to make sure that the journal entries are appropriate. On cash and cash equivalents, we do confirm 100% of cash accounts held by CHFA, test the bank reconciliations for accuracy, including reconciling items. We confirm 100% of the investments, and we test the fair value of the portfolio. On interest rate swaps, we make sure that the valuation and the effectiveness of the calculations is proper, and we also test the deferred inflows related to the interest rate swaps. Mortgage loans receivables, a lot of work there, of course, but that work has been primarily analytical procedures over loan interest income, detailed testing of the allowance, looking for bias, and making sure that the methodology being used to calculate that is reasonable and, of course, comparable to the prior years. All outstanding debt obligations are also confirmed by us at year end, and we're performing interest rate, interest expense calculations on that area as well. And then the final page wraps up the significant areas, the net pension liability and the OPEB liability. As mentioned, reviewing the assumptions, agreeing to the records of the state's plan, making sure that the allocations are proper. Revenue recognition is another significant area for us as auditors. We're making sure that revenue recognized is in the proper period, in accordance with accounting standards, primarily looking at the loan collection process for interest income. And then finally, the last significant audit area is the federal and state single audits. I think I described what we're doing there for testing, making sure that you're in compliance, that there were no findings, and that as well as the controls, making sure that there are proper controls over the compliance in the reporting. Are there any questions that I can answer about the audit? If I wasn't clear, all reports are unmodified and no findings to report to you.
Questions? Sounds like an extremely clean audit with really reflecting on the financial management and financial reporting of CHFA being very strong. Any discussion? Seeing none, we'll move on to financial reports with Allison Murphy.
Before you are the financial reports reflecting the results for the first 3 months of the year. On the revenue side, mortgage loan and investment interest revenue are coming in $4 million above budget through the end of March and $9.2 million higher than last year. On the expense side, bond interest expense is $3.6 million above budget through quarter end and $5.8 million higher than last year. The authority's outstanding bonds as of March 31st are $327 million higher than the same time last year. Plus, we're seeing higher interest rate costs on our variable rate bonds. Servicer fees are $2.9 million above budget through the end of March and $2.2 million higher than last year. The increase in single-family production is driving this variance. Administrative expenses are coming in $2.2 million below budget and $151,000 higher than last year. When you exclude salaries and benefits for $7.3 million, the current year expenses are $28,000 higher than last year. And lastly, the change in net position is above target by $480,000. Are there any questions?
So the single family production, just where our product offering is just much more competitive in this market.
Yes.
It's good.
It's also supported by the great product that they came out with, Time to Own too. They're a big percentage of their business is coming from piggybacking on the Time to Own product, which is an amazing program.
Got it. Yep.
I just had a question on the administrative and operating expenses. So you said when excluding salaries, you're 26,000 above. So is that just open positions that you're not able to fill? What is the?
Yeah, by the end of March, we had about 130 positions. So, and we do have 148 authorized. So
Okay.
yeah, we have quite a few vacant positions.
And those, does it make up any specific area that you're, or is it just across the board?
Pretty much across the board.
Okay. All right. Thank you.
And that's historically high.
So generally we run somewhere between 130 and 135. And then part of that is like attrition, replacement of new hires and sort of that variability. But so I think between 130 is currently our head count. We have 3 that are currently being recruited. And then we have 4 or 5 positions in development. So when there are vacancies, sometimes those positions will get we'll look at our needs and we'll make a determination about what the position might entail in the future, if it's in that same department or there might be a different need, and we'll we'll look at that sort of holistically before making a decision. So it's possible that we have 5 to 7 positions that are currently uncommitted.
Any other questions? Move on to production and delinquency report with John Chilson.
Good morning. Continuing on the topic of loan purchases, the authority funded 365 single-family loans in March, totaling $89 million. That's less than the 528 loans that were purchased in February, but February was a 22-year high. But it's 110 more than March of 2023. So the purchasing trend continues to run very strong. We included an additional exhibit in this month's report that shows a rolling 13-month trend line of mortgage purchases, both in dollars and number. The 97% of March's production was securitized, or $86 million, and the remaining 12 loans for $3 million were whole loans. The average loan size for March was just under $244,000. And the March month-end mortgage-backed security portfolio balance was $2.9 million, which was $75 million increase over February. While the whole loan portfolio for February declined by 33 loans, or $5.5 million, ending with a portfolio balance of $1.1 billion. So the combined single-family portfolio balance now is both MBS and whole loan is $4 billion. The single-family delinquency rate continues to run very low at 1.25%, and as does the number of loans in foreclosure. The year-over-year trend is current balance is about just under $11 million, which is less than $9 million over last year, and the number of foreclosures decreased year-over-year by 71. Authority also funded 180 down payment assistance loans for $2.2 million, with average loan size of $12,000, and 184 time to own forgivable loans of $5.7 million, and average loan size of $31,000. On our multifamily portfolio, the portfolio increased by 2 loans for March, 583 loans totaling $1.3 billion. There were 6 permanent loan delinquencies, no construction loan delinquencies. The overall delinquency rate for the multifamily portfolio was less than 0.5%. Any questions?
Just really quickly, and I'm sorry I didn't have a chance to look back at this last night, but in terms of delinquency right now, it seems like I feel like historically we were below the national average and even New England. Are we starting to creep up there? Is that what I saw?
Not yet. I do anticipate some of that will normalize, but right now, our single family portfolio loan on its own is just over 4%, which is very low.
Okay.
Particularly given the nature of our borrower being a first-time home buyer, which is generally considered a higher risk portfolio. It's very strong right now.
And strong, but in comparison to the national in New England, maybe you don't know the.
Yeah, New England, it's I can add it on my head, and it's just under 5%. So it's not a significant difference, but it's probably 40 or 50 basis points difference than the New England average.
Okay, thank you.
Any other questions for John?
I had my hand up.
Oh, I'm sorry, Commissioner. Go ahead.
I just wanted to piggyback on the question that Tim was asking. That what I'm seeing and the reports that I get is that at least in the residential side, delinquencies are not really tick up yet. And to be honest, we don't expect it to, because the value of houses is still very high. And the people run into problem, unlike in prior crises, they're not underwater, right? They could refinance, or if they sell, there will be equity. Where we have been seeing some delinquencies uptick, and in some cases significant, as in consumer loans, whether it's car loans or personal loans.
Thank you.
I was giving information.
I have a question.
Yes, please.
So John, do you compare yourself delinquency wise to like FHA's national delinquency percentages?
Yes, yes.
Because I mean, if you look at that, it's like, holy cow, you guys are like killing it in comparison to what I mean, understanding that that's a standard, a similar borrower, low down payment. I mean, like last I read in February, I think the delinquencies for FHA was pushing near 10%. So I mean, delinquencies are in excess of, so like, I mean, I don't want to downplay the quality of your book either, because like delinquencies might be ticking up, but comparatively, you guys are killing it. And then my next question, my other question is, you had 180 down payment assistance program and 184 time to own. Is there concern with that the product for when the time to own product goes away, or if it ever goes away, that there could be an effect of a volume decrease? And how would that affect? I mean, I guess the funding, there's still funding left to time to own, but if it was 180 second mortgages with down payment assistance and 184 were forgivable seconds, and there were a total of 365, is it like, is everybody getting a down payment assistance or a time to own? And if time to own goes away, is it your origination goes in half? That's a question.
Question.
Yeah, it's a little hard to compare, our timing of reimbursing for a TTO and DAP is a little different than our date of purchase.
Yeah.
And so if you may have noticed month to month, sometimes we even had more DAPs, TTOs than loans purchased.
Yeah.
Kind of hard to compare. I know before the TTO program, and our timing was more aligned with the DAP and loan purchases. Predictability of percentage of our borrowers using the DAP was difficult because it swung wildly month to month. Some months it would be high as 90% of the loans purchased, and sometimes it'd be less than 50% of the loans purchased. So, you know, I think we'd have to do a long-term trend analysis to try to find that some correlation.
I mean, in general, I would say the usage of DAP increased when we included closing cost assistance as an eligible expense for the usage of DAP. I believe it did go up significantly. Not every loan has time to own. I want to say like 60%.
Say 50.
50%, okay. But I mean, it's a good question because I believe that the production is being driven partly by the interest rate advantage, but significantly also with the forgivable aspect of the down payment assistance. So if we would want to maintain this level of production, I do believe we would want to have access to both types of resources. How we do that is obviously an open question for us to explore and figure out.
I mean, when does time to own run out? Is it like
Through the end of FY 25?
25.
Yeah. So
so
June 30th of 25.
yeah, so yeah, there's time. Okay.
It'll go by really fast, I'm sure.
Yes.
Any other questions? Discussion. On to investment and swap report with Ning Young Lee.
Thank you. In summary, the investment report shows an overall increase in book value by $347 million to reach $4.2 billion. And there is an increase in program assets by $266 million to $2.9 billion by the end of the first quarter. And quarter over quarter, the weighted yield to maturity for the investment portfolio increased from 4.06% to 4.25%. On the swap side, the swap report shows a hedging position of $924.8 million notional amount. This is the same as the last quarter. There are currently 42 swaps with 8 counterparties. The pay rate by the authority remained the same as prior quarter, which is 2.961%. The mark-to-market value increased from 24.996 million to 45.41 million. That's it. Thank you.
Any questions for Ning Yang? Okay, on to bond pricing results, Tahib. Azim Tahib.
Hey, so the last item is just to address a question that we received when BofA was here to present the 2024 A pricing book. So we received the data from BofA and then we created the chart. So Lorraine, can you go to the next page? So if you look at this chart, this is trying to show the last deal that we closed, the 2024A, and comparing it to all the deals that we closed in 2023. And if we just compare solely based on spread to MMD, a person will deduce that 2023D performed the best. But then when you go to the next page, so Lorraine, when you compare it based on the final interest rate, 2023D cost the most. So this is one of the things that, you know, when we present to finance committee, that we like to make committee aware that generally when it comes to bond pricing, there's about 3 items that come into play majority of the time. One is about market sentiment. So it's about the behavior and the predictability about and the speculation about the Fed rate cut, geopolitical. Then you also have the tax-exempt ratios, whether the rate is compressed or not, because the higher the interest rate, the more valuable the tax-exempt is. And then you also have the supply and demand, where, you know, the more supply, then you have investors demanding more pickup on the yield because they want to, in effect, make it better for the investor. And then also demand. So if you have a period where there's a redemption and investors are looking to invest their proceeds, then there's always opportunity to seek a better execution from those investors. So the net result is we just wanted to show, and then we will ask our bankers when they do present to the committee to at least show the spread to MMD and get any feedback that you would like them to touch on.
It's really interesting, Hazim, but again, I don't see, I guess I fail to see absolute, we have no control over absolute rate because interest rates will go up and down, right? In just general market. I don't hold the underwriters responsible for what the absolute rate is, because they have to sell into a market that's determined by global credit markets. We should be tracking underwriter performance by spread, right? And so I understand that the best performance was the highest rate, right? Right is what you're basically saying, is that the highest rate that we got on the 23Ds was also our best performer, yet it was the highest rate. But that's just a function of rate cycle, right? So to me, it's like I also understand that not every component of the spread is the underwriter's responsibility because of lots of stuff, right? So, and I understand that too, but it seems if we're going to come up with a transparent, repeatable measurement of bond performance, what we should be tracking is our spread to MMD, knowing that it's not going to be perfect and it doesn't tell the whole story, but still, instead of them my criticism of the pricing books by the underwriters is always the same. They cherry pick a bunch of deals you know, that make their deal performance look good, and it goes in the pricing book and it lacks context, and I don't know enough about like how Nebraska is going to trade versus Connecticut, and they show us that, and or some other state that maybe is typically cheap, whatever. But and so to me, what we should be comparing is our historical spread, and that's what we care about. And so if we look at a situation where we are wide to our historical spread, and the underwriters say, well, here's why, because you know rates are down, and when rates are down, your spread has a tendency to widen, or whatever the reasons are. Some of them are going to be good and some of them are going to be bad. But that's, to me, the best way that we can compare underwriter performance in a reasonably transparent, repeatable way.
No, that makes sense. I think my whole point is, as long as there's a qualifier, and because they know that, and that I do insist on them executing and delivering the best result for CHFA. So they know that.
Yeah, I think they do a good job for you. I do. I don't think there's a problem at all. I think they generally do perform really well, and I think you've managed it really, really well. But I think more it's the substance of the nature of the pricing books, which I find,
which is fine. No, and I appreciate that, because I think that my whole intent, as always, ever since I introduced this whole pricing book, is to offer some insight to the committee about how things get done. So trying to educate, trying to familiarize, so that you can have this discussion or ask any questions. So if it's important to show the spread to MMD, yeah, we'll include them in, and then we'll ask the underwriters to explain, you know, why is higher or why is lower, because that's the only way you learn what transpired during the sale.
Yeah, if we see a deal where our spread to MMD is really high than what's historically been, that's the interesting conversation to have with an underwriter. Like, well, why is that? And I'm not saying that they that they did something wrong, but that's the right conversation. And then it's important to have conversation. And if it happens again next year when they come up for rotation, you know, then it's a much more interesting conversation. And that's all I think that we should try to get ourselves set up for.
Sure.
I might suggest something. There's an annual report that our financial advisor has provided to other clients that can summarize performance across different underwriters over the same period of time, and could evaluate other aspects of performance, including like remarketing and remarketing fees and spreads, you know, all of that sort of stuff that goes along with the work that they do. So that's something we could look at.
Commissioner Perez, you have your hand up.
Yes, I do. I just want to go on record that I agree with Jerry's point. I mean, not that the final rate doesn't matter. It does matter also, but Jerry wasn't saying it doesn't matter. Because, like, for instance, in a lower environment, everybody's going to look better than they did the year before, right? Or the time before. But is it really because of their due diligence, or because of the market conditions, right? The same way it has our numbers. I don't want to take away anything from the production numbers, but let's be real honest, intellectually honest. When you have time to own and you basically the only game in town, your numbers should go up. The fact that we were set up and took advantage of the opportunity, we should be complimented for that. But at the end of the day, we had the best product in the market. We should have production go up. The same way that when rates go down, it had nothing to do with who the underwriter was. You know, the rates are going to be lower. So I'm not saying that having this chart, it has no meaning or significance, but I totally agree with Jerry that maybe the spread and even the fees that they charge probably be a better, you know, a better measure for us to really grade what's in the control of the underwriter.
I find it's very hard to measure underwriter performance just by spread because there are so many factors that go into the pricing on any day. And I think that's what the pricing books try to capture, other deals in the market, the tone going into the market. There are so many things that can impact. And it's hard to simply look at the MMD spread and say that that's their performance. But what we do here at the state occasionally is we do a competitive sale to kind of test our spreads. And I don't think CHFA does competitive sales, but we're planning to do in the summer. Do housing authorities ever do competitive sales?
Only Virginia. That I know of.
Because it's a little too complex for general competitive bidding. Is that the reason? Housing?
Yeah. And in part, just because when you sell housing bonds, you have to make sure that the investors really understand what they are buying. Because it is structured product in terms of what we're trying to sell.
Hey, Sarah, when Connecticut does competitive sales, and it's different, it's GO, I understand that. Is your performance on the competitive sales better or worse than negotiated? I know when I was a public finance investment banker, a lot of times the competitive sales didn't perform better than negotiated sales.
Well, it's interesting. On the TIC basis, sometimes it would be better. That's the all-in interest cost, but they play with the couponing. Like they do lower coupons, so you lose call optionality. So it's a little
So yeah.
So you do sometimes get on the face of it a lower overall interest cost, but you lose the ability to call the call option because they fiddle with the they do low coupons at the end to try to win the TIC math. But it is a good check, and we tend to do smaller sizes, and we're planning to do one this July.
Yeah, I think to your other point, I think you're right. I don't think you can look at any one deal and look at spread to MMD and draw too much conclusion. But my supposition is and since we're in the market all the time with essentially the same structure, right? Which is great. It's mature, market accepts it, same buyers, prepayments and what's in the market and all that affect that. What I would love to see, and what I'm trying to get CHFA set up for, is to have that data over a long series of time to see if patterns emerge. And if our intuition is telling us, well, no pattern will emerge because there's so many other factors, but then, and that's great. But my guess is that you will see patterns emerge. And when you look at the data, it will seem that some people are just luckier than others, and that's what I'm hoping we eventually find. And I think Hazim does a great job managing this. I don't think it's a problem. Our execution is really good. But it would be a great conversation to have with your next underwriter, 3 years from now, saying, you guys are typically, worse than our average on our spreads on zero bonds or back, and just give them a little warning, and you'll get a little better performance. That's because this is the one thing that the underwriters they create these huge, big pricing books. It's the one thing that's not in there. So I just am a little skeptical, and I'd love to see it in there, repeatable, so that and that's my only point.
And I like the idea of the financial advisor report, because the financial advisor is involved in the pricing and can isolate those other market conditions that may contribute to the spreads that are, to be considered.
Yep.
Any other discussion? Your last item today is approval of the minutes of the Finance and Audit Committee meeting on March 28th, 2024. May I have a motion? May I have a motion?
I wasn't there, but I'll move. I don't think I actually have to abstain, even though I wasn't there. I read them. I do have a question, though. I don't know who Bettina is.
Yeah, she's the assistant treasurer for debt management here at the Office of the Treasurer, and sat in for me when I was on vacation.
So just, and this isn't a big deal. In fact, it doesn't even really matter that much, but I am curious. We've got other committee members. Why would we have someone who's not a committee member chair as opposed to someone who's on the committee?
Well, that's been done in the past when deputy treasurer, for instance, sat in for me in the past. But I'm open to someone else chairing when I'm
No,
not
it
there.
was more of a question. I just found it when I read it. I was kind of like, I didn't know who it was, and wasn't someone I'd seen before. So it was more of a question, not a criticism, just an
Yep.
observation.
Okay, well, I'm open to a different approach, but I think that's what we've done in the past.
Okay, I didn't realize that. I don't recall someone else stepping in, but thank you.
I know Daryl Hill, when I was assistant treasurer and he was deputy, he sat in. But I'm open to letting someone else chair the meeting when I'm not there, if people would like that. No ownership there.
I think Phil would have done a tremendous job.
Yeah.
Thank you.
Okay. Let's see. So I have a motion. Do I have a second? For the minutes?
Phil, you were there.
Second.
Okay. We'll do a verbal vote unless there's some abstentions. We'll have to go to a roll call, but all in favor, say aye.
Aye.
Okay. Any abstentions?
I would abstain since I was not there. This is George.
Yes, thank you. Any disapprovals? Terry, do we need to do a roll call vote, or is that good enough what we have on tape?
That's good enough. Can
Okay,
I just ask who seconded it? I'm sorry, I didn't catch that.
I did.
Thank you.
okay. Any other matters to be discussed, or also let us know if there's any other topics you want to, cover, like generally in the future at this finance committee, like we did on the pricing. I thought that was good. Hearing none, then I'll have a motion to adjourn. All in favor?
Aye.
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 Thank you. We'll see you on the other side.
Thank you.
Thank you.